Hi there, welcome to Kneppy Invest and welcome to another technical update video. I'm doing something a little bit different in today's video. What I'm going to do is I'm going to borrow something I've been doing and using a lot when I'm looking at individual companies' charts, and that is using the 200-week moving average, thanks to Charlie Munger, who stated that if you bought high-quality companies at or near the 200-week moving average, you will significantly beat the market. I've had a look at that over the last maybe 3, 4, 5 weeks, and I think there is some truth to it. I really do. I think there is some truth to that. It could be a really good investing strategy. Just find high-quality companies, and when the share price dips to 200-week moving average, just buy some shares or add to your position, that sort of thing. And I actually might use that strategy moving forward. So I'm having a look at that strategy for individual companies. And then I was thinking just before I started recording, why not do this or look at this for indices, commodities, crypto, bonds, and currency? And that's what I'm going to do in today's video. I'm going to look at weekly charts for all those. I was going to include about 11 individual companies' charts in this video. I did put them at the end of this list of commodities and all that sort of thing, bonds and all that jazz. But what I might do instead of looking these 11 individual companies is I'll go through one of my screeners, more than likely either the 3-month high or 6-month high screener, because I actually haven't done that. Usually I do it at the end of every trading day, and I did not do that on Friday afternoon because of Appendix 4 Season 5Bs. So I might do that in this video just to save a bit of time. And that's just me being a little bit selfish. Anyway, so let's start off with indices. So what I've got in this particular chart is a weekly going back to 2014. So we've got 10 years of history here for the XJO. And the 200-week moving average is in black. Should I put it in black or leave it in black or maybe put it in blue? By the way, my favorite color is blue. Don't tell me what shade. I don't think I have it. Does it look better blue? I don't know. Definitely not red or green, but my favorite color is blue. I have no favorite shade. I don't care. I'm not one of those people who really cares about shades. Just blue is my favorite color. Always has been, probably always will be. Anyway, so I just wanted to say if you could use this sort of strategy just for the indices. For example, if the XJO falls below the 200-week moving average, is that a time to go to 100% cash? And if the XJO is well above the 200-week moving average, should we start increasing our cash levels? Which is something I'm thinking about doing right now. I'll be honest with you. I'm thinking that because I keep looking at some of my companies I do own, particularly in my high-quality portfolio, and I'm just looking at the valuation of some of these companies, and I do think they are stretched. And there is a definite possibility that I will be taking profits. And when I say taking profits, I don't mean completely selling out. I mean maybe selling half and maintaining the other half, because the companies I'm thinking about, those are up over 100%, like Aristocrat, up over 100% on that company. And if I take profits and the share price keeps on going up, who cares? I made this mistake with JB Hi-Fi. I completely sold out of that company because I thought the valuation was looking a little bit stretched. The share price has kept on going up. I should have just sold half. So I am really seriously thinking of doing that over the next few weeks. And that means I will probably increase my cash levels. And maybe that's fair enough. And let's have a look at the XJO chart to see if maybe that is a fine strategy based off where it is compared to the 200-week moving average. Now, if you look at the past 10 weeks, we have seen the XJO, or 10 years, not 10 weeks, 10 years. If we go back to the last 10 years, we have seen the XJO fall below the 200-week moving average on 1, 2, 3, 4, 5 occasions. If we go back further, you'll see it move below the 200-week moving average for quite a bit during the GFC. So I just want to look at the last 10 years, and maybe I'll just go back a little bit further in a second. So only 5 times over a 10-year period, so once every 2 years. The first time was during late 2015-16, early 2016. I was thinking just now, what call? I can't remember that. I cannot remember that. And I think the reason I cannot remember the XJO dipping during that period is because it's related to the iron ore cycle. The iron ore found a bottom in 2016. Just have a look at BHP's share price chart. You'll see the share price of BHP reached a low of about $16 started 2016. So I think that is what happened during that period. It was just the SEO was down because of iron ore. And that's probably why I don't remember it all that well, because I wouldn't have been highly invested in any sort of mining companies at that point. I definitely remember the end of 2018, and it dipped below the 200-week moving average briefly. That was during the, I wouldn't say fear, but the thought that interest rates will start rising in America. We saw a fair bit of weakness in the Nasdaq, that sort of thing. So not surprising to see the SEO fall below the 200-week moving average there. So that would have been a great time to buy. And yeah, and I think it was start of January 2019, the markets just took off because that threat had come to an end. And then, of course, COVID-19. That was a pretty obvious one. The question about COVID-19 was just how far it would fall. I had buys. I was thinking about buying at around about 4,400. It got very close to 4,400. I shouldn't have had a price target. That was my big problem there. I should have been starting to buy well below 5,000, maybe not well below 5,000, but just below 5,000, and really ramped up my buying the lower it fell. This should have been my strategy back then, but my mistake was having a price target. It fell briefly below the 200-week moving average in June and probably October 2022, and that was in relation to increasing interest rates, tech sell-off, that sort of thing. Still remember June 2022 because a really bad day on my birthday, June 14th, and there was sort of a double bottom at that point. And we also saw the SEO fall briefly below the 200-week moving average in October 2023. Now, the SEO is well above the 200-week moving average. Now, I just wish there was a bit of a standard deviation here. How much of a standard deviation is above the 200-week moving average? Because at times it does get quite a bit above. So we saw it well above in March 2015, and then there was a fair bit of weakness. It was well above just before COVID-19. And in fact, I was selling a fair bit of shares back then to put to my mortgage because I didn't think there was going to be much of a return moving forward, because I thought the market was expensive at that point, and I was willing to sell down my mortgage at that point. And we also saw the SEO looking a bit frothy back in August 2021. And that was at the end of 11 months in a row where the market was up, or something like it was something like that, yeah. And then the market fell because of tech sell-off. And then right now could be another time, but we just don't know how much further it has to run. So I would say and argue that the market is looking just a little bit frothy, and this particular chart could back that up. Okay, so that's the XJO. Just looking at the last 10 years. If we go a little bit further back, we can see during the GFC, it fell well below it and really struggled for the next few years. In fact, about 3 or 4 years, it really struggled to get it back above. But once it did, I think, it was a pretty good strategy just to look at or buy when it got below the 200-week moving average. And before the GFC, just look at that massive bull run. What a bull run that was. Beautiful bull run. And again, it was well above the 200-week moving average for a long, long time, for about 2 or 3 years. And I do know, I have heard some experts, some professional investors say they were selling, not only then, but they were selling before the tech bubble burst, like 2 years ahead. And a lot of these professionals say, well, we shouldn't have just, assumed the market was expensive and started selling. We should have waited for something like a trigger to sell, and they just sold too early. So that's the problem. Maybe not the problem, but that is one of the things about bubbles. They can last for a long time. The market can remain irrational for a long, long time. And maybe that's what's happening now. Maybe the market will just keep on going up for the next 3 or 4 years. And that's one thing I am mindful of. Another reason why I don't want to completely sell out. And what I would do with my money is then deploy it for trades, that sort of thing. And I think once it does get a little bit frothy, maybe trading is the way to go, because if you trade and the market starts to fall, you can sell to go to more cash. Now, I hope that makes sense. Okay, so it seems like an okay strategy over the last 15 years, maybe 15 years, we'll say 12 or 13 years, that whenever the SEO falls below 200-week moving average is a good time to buy or go to completely to cash. What about the XSO? I'm doubtful about this one. I'll tell you this. I'm really doubtful about this one. And the reason behind that is because the XSO has not reached an all-time high. All-time high was still in 2007. So I'm thinking this is not going to look good. Yeah, so there it is. The high way back in 2007. In fact, there are periods of time when the XSO is below the 200-week moving average for 5 years. We saw that between 2011 and 2016, and we saw it below the 200-week moving average for about 2 years between 2022 and 2024. I don't know. I'm not sure this would work for the XSO. Yeah, I don't know. I'm going to say no for this one. Okay, so let's have a look at the American markets, indices, not the markets, indices. And we'll start with the Nasdaq. And I would say, yes, I would say whenever the Nasdaq gets towards even below the 200-week moving average, a great time to buy. I did that in 2022. I think the last 6 months of 2022, I added a lot of American companies to my portfolio during that period because a lot of those companies looked really good valuation-wise compared to the historical levels. So I did take advantage then. So let's have a look if the Nasdaq was screaming buy in late 2022. Okay, so let's have a look, and it was. Yes, I'm so thankful it was. By the way, I did not have a look at this beforehand. This looks pretty good. This actually looks really good. Funny enough, let's go back in time. Okay, it's funny that the GFC is just a little blip. It's just a little blip, fell below it, and then rallied really quickly. You can't even see really the GFC. I would say the tech bubble, yeah, look at that. Oh, jeez. That's a bubble if ever there was one. That's the chart of a bubble. Look at just the rise, massive rise, and accelerates once it gets to the top of the bubble. It just accelerates. The lasts probably from October 1999 through to March 2000. October 9, yeah, this is weekly. So that's, how long is that? That's about 4 months. It just accelerated. And then it reached the top and then burst. Anyway, so and then the Nasdaq fell below the 200-week moving range for a long time, and that just shows you how frothy it was at the top of the bubble. Anyway, so if we go forward in time, we had the GFC. There it is, and really since September, August 2009, the Nasdaq has been above the 200-week moving average. During COVID-19, it touched the 200-week moving average beautifully. It just touched it perfection. By the way, in late 2018, it got very close to the 200-week moving average, very close indeed. That was a good time to buy. Good time to buy during COVID-19. And then when I was buying a lot of companies in late 2022, by the way, I was not looking at this. It just seemed a really good time to buy these high-quality companies at a really good value. And this sort of verifies that. In fact, the Nasdaq did fall below the 200-week moving average for a period of time between September and January 2023. And look what it's done since then. The low during that period was around about 10,600. It's doubled. It has doubled. It has doubled. The Nasdaq has doubled in the past 2 years. Oh, that's insane. Thank you, NVIDIA. Anyway, so it sounds like this strategy will work for the Nasdaq, but it doesn't happen all that often. In fact, in the last 15 years, it's done it 3 times. Sometimes it gets close. Yeah, sometimes it gets close. So it's done it a few times, but definitely a good signal for the Nasdaq is whenever it gets below the 200-week moving average, could be a good time to buy. By the way, right now it's well above it, just like it was just before the drop in 2022. So it doesn't mean it's time to sell, but I'm just saying. What about Dow Jones? Is this another index? I have no thoughts, any opinions of this one. I would assume it works well for this one as well. So Nasdaq, Dow Jones. Let's have a look. Yeah, it works well. Interesting enough, you don't see the tech bubble burst here at all. Just different indices, isn't it right? Comparing the Dow Jones Industrial to the Nasdaq in 1999 through to 2001, it's night and day difference. And even during the GFC, it's night and day difference. Dow Jones Industrial really fell off. In fact, the bottom of the GFC was, what's that, a 12-year low. So we definitely saw it fall below the 200-week moving average just after the tech bubble burst for maybe a year. And then, yeah, definitely during the GFC, which is understandable. So probably another thing is, if we do see a significant recession, probably the indices will fall significantly below the 200-week moving average. But we have seen the Dow Jones touch the 200-week moving average quite often. 1, 2, 3, 4, and that was in late 2018. During the COVID-19 financial panic, it fell right through it, but recovered fairly quickly. And it just fell below for a brief period in October 2022. It touched it in June 2022 and then rebounded, fell through it briefly, and then took off again. And right now, the Dow Jones is well above the 200-week moving average, which is telling us maybe it's not the time to be buying and buying and buying. Anyway, so it works. I think it works well for the Dow Jones, works well for the Nasdaq, works well for the XJO, maybe not the XSO. What about the Russell 2000? This could be interesting. Small caps in the United States, and I'm skeptical. It's better than the XSO. We know that. I suppose just looking at this, it works okay. I don't think it works as well as Nasdaq and Dow Jones. We can see that in between 2022 and 2024, it was oscillating above and below the 200-week moving average for about 2 years. But generally, it is going up. Small caps is going up through time, but not as clear as a signal as we saw with Nasdaq and Dow Jones. But still, I don't think you can go wrong if you buy small caps in the United States when the Russell 2000 is below the 200-week moving average. But maybe you have to be a little bit more patient than the Nasdaq and Dow Jones. Okay, so I think it works pretty well, particularly Nasdaq, Dow Jones, XGO, not so well for the small caps. Now let's have a look at some international indices. So we'll have a look at the Nikkei, Hang Seng, DAX, and FTSE. I'm trying to think of some other indices I could use, but those are the 4 that I can think of right now and have always thought of. What about the Nikkei? Well, we know Nikkei reached a peak in late 1989 or early 1990, went in a downtrend for a long, long time, moved into an uptrend, it was about 10 years ago, maybe, and then reached a new peak not that long ago. So that would mean I think the Nikkei has been in a really good uptrend for about 10 years. So I would say this has worked for the last 10 years, but between 1990 and maybe 2010, it did not work because it was in a downtrend. And okay, so it moved into an uptrend in late 2022, early 2013. So yeah, about 11 years ago, 10 years ago. I said 10 years. And actually it does work. It does work. Since then, it does work. It does work. So we saw it like, sort of hit the 200-week moving average in 2016. That was a good time to buy. COVID-19, good time to buy. And look at this. Back in 2022 and early 2023, the Nikkei hit this moving average quite a few times and then bounced off it. It went sideways for a while here, but then as soon as it started hitting the 200-week moving average, that was a time to buy. And then during the yen free carry trade, what do they call it? I forget what they call it. It got so close to 200-week moving average. It almost hit it. It almost hit it to perfection. I like this. I do like this. So it has definitely worked over the last 11 years. But before that, downtrend. Yeah, look at that. In fact, probably the complete opposite. You short sell or you sell short whenever it gets above the 200-week moving average for a period of about 20 years. So the Nikkei reached a peak. It was January 1990. Yeah, I wasn't sure if it was late 89 or early 1990. It was quite early 1990, and it just got past that peak not that long ago. So it took, 30 plus years to get above those levels. This is another definition of a bubble. Look at that. This one didn't really accelerate near the end. But yeah, geez, another example of a bubble. Okay, what about Hang Seng? I don't have any trust in the Hang Seng, and the reason behind that is because it's been in a downtrend for a while. So is this the sort of the global financial crisis equivalent for the Hang Seng? Maybe, maybe. I just want to see what it does before or did before that. Ooh, I don't like this one. Don't like this one at all. This goes back. This goes back 30 odd years, and I don't like it at all. There's just I don't see any signal here, unlike some of these other indices. So I'm going to move on. I don't see anything here to like. So let's move. Let's look at DAX. I would say more than likely this is a pretty good one as well. Uh, it looks okay. It looks pretty good. Maybe not as good as some of the other ones, but definitely when the DAX does go below the 200-week moving average is a time to think about buying some German companies. It does it quite often. Yeah, I'm seeing about 5 or 6 times here, maybe even more than that. 1, 2, 3, 4, 5, 6, 7, 8, 9, almost 10 times. And actually look at the DAX now where it is. And remember, the DAX is just going bananas when the German economy is in the toilet. And I'm just saying, I'm just like, it does look a little bit stretched at this point in time. Maybe not a bubble, but looks a little bit stretched. What about the FTSE? FTSE, I don't know about this one. I don't know. I don't know. It's not my favorite, I'll tell you that much. The FTSE is just slowly grinding up. Yeah, I don't like this one at all. In fact, the FTSE falls below the 200-week moving average by a fair bit quite often. And we've seen that, well, this is over a 30-year period, and it's fallen below it, 3 times, well below the 200-week moving average about 3 times. And it does it quite often. Not as bad as the XSO, but not my favorite. If I did have to pick my favorite, it'd probably be the Nasdaq or the Dow Jones. I don't mind the XGO, but definitely those 3 would be my favorite out of these 3. Anyway, so that could be good strategy. When you see one of these indices, particularly those 3 I mentioned, fall below the 200-week moving average, maybe you can become a little bit more bullish. Maybe go more to cash than not cash. Now, can we use this for commodities? Maybe. I don't know. Yeah, maybe not. I'm thinking this is more of a stock picking thingy. And that's why indices might be useful, because I think it might be more relevant for stocks because it really equates to high quality. And when you think of high quality companies, you do think of Nasdaq, which is littered with high quality companies, particularly the top of that index. Dow Jones have a lot of high quality companies on it. ASX, not quite as much. But there are a few companies that have high quality near the top of that particular index. I'm thinking CSL. But when I think of commodities, I just don't think high quality. But can we use this strategy for commodities? So this is gold. Possibly what we can do is look at the valuation. Is it stretched? Now, over a long period of time, this goes back to 2000. Yeah, no, I don't think you can use this, because gold went below the 200-week moving average and stayed below for a long time, and was sort of oscillating above and below between about 2013 and 2019. So about 6-year period where gold just did nothing. Now, since then, since it really took off in middle of 2019, only once has it fallen below the 200-week moving average, and that was back in October 2022, when, in fact, the market also fell below the 200-week moving average. And if you have a look at gold right now, in comparison to the 200-week moving average, it's well above it. So this is a sort of situation where if it did pull back a fair bit, it could pull back. It could pull back a fair bit. So maybe this could help us make decisions when it comes to gold companies. I don't know. Maybe you could just argue that gold is looking a little bit frothy at these levels. I don't know. What about silver? I didn't expect much with silver. If you look at the long term, what we'll do is have a look at 15-year period. Have a look at this. And when I look at silver, I go, no. Just, I don't think you can use That for silver. In fact, silver hasn't got back to its highs, which was reached in 2011. What about iron ore? No, can't use it. I'm going to say that right now. Can't use it. It's definitely nothing like the Nasdaq, Dow Jones, and the XJO. What about iron ore? And no, absolutely not. Maybe you could say, well, if it's well below the 200-week moving average, that's when you could buy, but you don't really need the 200-week moving average for that. I would always say if iron ore falls below, I've said 90 or 80, that's a good time to buy. If it falls like to 40, that's a great time to buy. And you can see in 2016, late 2015, 2016, iron ore got to like $36. That's why our market tanked in 2015. It's because of iron ore. So not really for iron ore. Uranium is going to look interesting the last few years, yeah. So uranium definitely has taken off. Interesting enough, if you go from 2009 all the way through to 2020, it's in a downtrend, and you can just see it change trend. That's why this chart looks interesting. And funny enough, when uranium got well above the 200-week moving average, we have seen a fair bit of weakness since then. So yeah, it's went well above, and we've seen it pull back, and it's getting close to the 200-week moving average. So maybe now's the time to get interested in uranium. Maybe that's how you can use this chart. What about oil? Well, oil is just it's going to be nothing. This is going to be pointless, this one. Yeah, this pointless. It's been going sideways for 20 years. Oil's been going sideways for 20 years. No trend. We could look at gas, lithium, coal. We're not going to see anything here. What about tin? We might not have enough data points for this one. No. Nickel. No, nickel's going to look terrible. Yep. What else do we have? Palladium. What about palladium? Actually, interesting with palladium, if you just exclude the last year or so, before that, so yeah, actually there was periods of time when it fell below that moving average, and that was a good time to buy. And then it took off in 2017-18 and looked pretty good, but unfortunately, its palladium has fallen into a bit of a hole over the last 2 years. So not looking good anymore. Well, this could be like the GFC. In fact, if you equate this to, say, the GFC, like the Dow Jones, now's the time to buy palladium. It's the bottom. It's the bottom. In fact, I could actually see that argument. It looks like it has formed a bit of a floor or a base, with the bottom being around about there. Yeah, I actually can imagine that. There you go. By the way, I excluded all my drawings, so yeah, there it is. And what about cocoa? Whoa, geez, cocoa. Look at that, cocoa going sideways for many, many years, and then because of cocoa shortages, through the roof. I don't think it's cocoa short. It has to be cocoa shortages because demand hasn't. So supply and demand's probably the same. So it has to be supply shortages. So probably growing conditions in West Africa have been not optimal. Okay, what about Bitcoin and Ethereum? Can we use this? Where is my... Oh, that's right, it's in blue. For some reason, I thought it was in red. I was looking for red. There was no red here. Can we use this strategy for crypto? Now, we really have to think hard about this one. So it really starts in 2015. That's when we start the 200-week moving average. And it started just above that particular moving average. And you could say after this acceleration in the price in 2017, it pulled back briefly below the 200-week moving average. That was the time to buy based off history or based off what happened after. And then it fell just below the 200-week moving average briefly during COVID-19. That was the time to buy. And then accelerated again in 2021. And then it fell below the 200-week moving average for probably a longer period than what I would like, between June 2022 and March 2023. So we're talking about a 9-month period where the price of Bitcoin fell below that. So you could probably argue again that was a time to buy. And right now, Bitcoin is well above that particular moving average. In fact, The distance between the price of Bitcoin now and that particular moving average is probably the greatest it has been, maybe by percentage, or maybe not. I think this percentage would be the highest here back in 2021. Actually, no, probably a little bit further, like this percentage here back in 2017 would be worse. Yeah, definitely. That's definitely, yeah. Okay, so maybe it does work for Bitcoin. What about Ethereum? Not much difference, actually. Interesting enough, in the past year or so, we've seen Ethereum hit the 200-week moving average, and then a lot of buying has come in. That's happened twice. And it happened also in October 2023. So maybe. What about bonds? I just don't think, I'm just not going to see anything. Well, bonds have been in a downtrend. Well, bonds were in a massive downtrend for, was it 30 or 40 years? And you'll be able to see that in this chart. So this goes back to 1988. Look at that downtrend. In fact, this is absolutely reverse of what I've been talking about. Whenever the bond yields got above the 200-week moving average, you short sell. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, and then when you did it on the 13th time, you've lost. So you had 13 times where, well, 12 times it was successful, and then the 13th time it didn't, and that's when bond yields move into an uptrend. So it works on reverse in this one. And what about currency? This is Australian dollar, and well, this makes sense. This actually does make sense. I'll be honest with you. This actually really makes sense because look, when Australian dollar was above $1 American, that was in 2011. I should have traveled that year. Really should have traveled that year. Anyway, but not surprising this doesn't work because the trend's not up. Like, we expect indices for the trend to be up. It's not a, you won't see that. Must be some way to say it. It's going to remain in a range forever, really. And that range is probably between 50 cents and $1.10. Yeah, 50 cents is the low, $1.10. Well, back in the 70s, it was much higher, but over the past 40 years, the high has been $1.10. And it's really been trading between, in fact, if you take away that period when it was $1.10, it's been trading between, say, 90 cents and really about 60 cents. Yeah, 60 and 90 cents. Okay, so some of the companies I was going to show you the chart include BetMakers, Tabcorp, Crow Foundation, I think it's called, ACF, Deterra Royalty, Nine Entertainment, Ad Labs, I think it's called, AAL, Max 7, EBOS, Magellan Financial, and a couple of banks, NAB and Westpac, are very close to being maybe double, even triple tops, or they could break out. If they get above that triple top level or double top level, sort of a continuation of an uptrend. But what I want to do instead is have a look at one of my screeners, and that screener is companies at our 3-month high. Oh, it's on it right now. That's excellent. So what I usually do is I look at a 100 MA cross, moving average cross. That's usually the first one I look at, only 29 matches. The second one I look at is either unusual volume 3 times, 5 times, or 10 times. Usually I just stick to 5 times, and this would have like 50, 60 matches, 79 matches. And then I either look at the 3-month high or 6-month high. 6-month high won't have as many, so 85 matches, and the 3-month high would have, I'm assuming, where is it? 3-month high would have 120. Oh, 257. Well off on that one. Oh, gee. So that's a lot of companies. Now, I won't have a look at all these. I will probably limit to like market cap above $100 million because there's going to be a lot of really small companies. Interesting enough, the biggest company that is at a 3-month high is Macquarie Group. We'll go back to daily chart. I do like to go through these and just see how many companies I own or trade. So I don't own or trade Macquarie Group. Would I like owning Macquarie Group? Yes, I could imagine myself owning Macquarie Group. Yeah, I could definitely imagine myself, and I have held this in the past. In fact, because I held Macquarie Group many, many years ago, I got Was it Sydney Airport shares you got if you owned Macquarie Group? This was many, many years ago. I just remember getting all these shares of, I think it was Sydney Airport. That's when I owned Macquarie Group, and I should never have sold out. Wesfarmers, I've never owned Wesfarmers. That is second on this list at a new 3-month high, just above the previous highs we saw, or this company saw back in August. This is not a company I own, have ever owned. Am I willing to own this? Yes. But if I need to see value, I need to see some good value, and I don't see it with Wesfarmers right now. A company I am really thinking of taking profits, Aristocrat. I think it was a couple of broker upgrades. I do get nervous around that. This one. If you have a look at the weekly chart, you can see what I mean. So I bought when the share price was right on the 200-week moving average. That was not planned. I just saw value. I saw some really good value. And look where the share price is now compared to the 200-week moving average. It's well above it. That's why I'm thinking, oh, it's a little bit stretched. Anyway, so Aristocrat, a new 3-month high. It's probably also a 6-month high. In fact, it's an all-time high. QBE, I am trading QBE, and I would assume the other insurance companies are on this list as well. A long-term high for QBE. Pro Medicus, I own this one, have held it for a while. Do I have it in here where I bought? There is me buying at 55.25. And when I bought at 55.25 back in late 2022, I thought, I reckon this company is really expensive, so I'll just buy a few shares. When I say a few, I mean, I think it was $3,000 worth. And I thought, if the share price goes up, or because I think it's overvalued, I think the share price might drop. So if the share price does drop, I'll buy some more shares. And the share price did not drop. Has not dropped at all. And this is another one which I have really been fighting with myself. There's no doubt Pro Medicus is significantly overvalued, but I just can't sell. Just can't. I think the PE ratio is like 250. Not 343.6. And it just got to a new all-time high on Friday. Pro Medicus, Zero is another one that I do own for the long term. This one is where I think it's oscillating, not oscillating, but I could definitely argue that it's not a high-quality company yet, but I think it has the characteristics of becoming a high-quality company in the future, and I think the market agrees with that. And another company where the share price is at an all-time high. I think it's an all-time high. Yep, all-time high. Funny enough, I bought Zero also when the share price fell below the 200-week moving average. There you go. So I bought somewhere in here. I should mark it down where I bought it. By the way, Pro Medicus, did I buy that at the 200-week moving average? The answer to that is no. But it did touch the 200-week moving average about 5 months before I bought. There you go. In fact, Pro Medicus has touched the 200-week moving average twice. Once during COVID-19, once during June 2022, and probably before that as well. No, that's only 2 times in the last 13 years. Suncorp, yep, Suncorp. By the way, yeah, would I call this a high-quality company? No, look at the chart. This is the 10-year chart. No. Share price has just taken off because all insurance companies have taken off. By the way, QBE, this is the weekly chart for QBE. Yeah, this is not the chart of a high-quality company, but the chart looks really good right now. That's why I'm trading it. And Coles is at a 3-month high. I am wondering if people are going from Woolworths to Coles. And this is the weekly chart for Coles. Is this a high-quality company? No, I don't think it is. That's just my thoughts. I don't see significant growth moving forward for Coles. And in fact, with the share price at almost an all-time high, I could actually argue this is really expensive. PE ratio 23.3 for a company that's not going to grow all that much. That's another sign that I think there are some portions of the market that are really overvalued right now. And Coles is one of them, banks are another one, particularly CBA. Then we have IAG. And look at that chart. Oh, that's actually really, really not a high-quality company again. The share price has just taken off over the last few years. Share price has more than doubled, and share price is now at an all-time high. I think we might have to go a little bit further back to verify. Yes, all-time high. And the reason I would not say this is a high quality company, you can see even though over time share price has increased, this to me is more of a trading stock. You can see share price rises and then drops, rises and drops by a fair bit. So for me, that is more of a trading stock. Cochlear, I was a Cochlear shareholder not that long ago, and this is the chart of a high quality company. And we do often see the share price drop below the 200-week moving average, and it's a perfect time to buy this company. Hasn't dropped below it since December 2022, but share price is at a 3-month high, but probably not a 6-month high. There you go. CPU, no interest in this one. Share price has taken off because of increasing bond yields. This is more of a bond proxy, in my opinion. I have no interest at all. And JB Hi-Fi, there you go. PE ratio of 25.4. Typical PE ratio for JB Hi-Fi is between about 10 and 18, I think. And that's why I sold, and I shouldn't have done that. I should have probably sold half and maintained the other half, and share price just keeps on increasing. In fact, if you have a look at the weekly chart, oh yeah, this is another reason. Look at that. Look how far away the share price is from the 200-week moving average. And yeah, so whenever you see it well above the 200-week moving average, you don't see it go for much longer. And again, this is another company where just have a look at the share prices compared to the 200-week moving average. And since 2013, those have been the times to buy. And I did buy JB Hi-Fi when it was below or near the 200-week moving average in late 2022 because I saw really good value. I think the PE ratio was 12. Actually, no, it could have been 8. So for some reason, I have a feeling it was 8 when I bought. Yeah, so that's JB Hi-Fi. What else do we have here? We have Medibank, which could be interesting. Is this the chart of a high-quality company? Share price has been going up, slowly up. I would say if you really, really want to own this one, it does fall below the 200-week moving average quite often. And there is a trend here. There's the uptrend. So I'd buy this if it was $2.90. Share price is now $4. Vicinity centers, nah, not for me at all. Why? Just have a look at this 10-year chart. Share price is lower now than it was back 10 years ago. Telix Pharmaceuticals, I think we can move on from this one. Chart looks phenomenal. Probably share price just keeps on going up. Probably another case where it looks expensive, but I'm less willing to sell this one than I am Pro Medicus just because of the significant growth this company has going for it. Now, Pro Medicus has pretty good growth, but I don't think all that growth has been completely priced into Telix just yet, and potential growth. I thought this company was expensive when I bought at 666. The devil doesn't want me to say that number, and share price now is $29.34. I bought in October 2022, again, that period, and but I didn't buy because I thought it was cheap. I bought because of an amazing Appendix 4C from the company, and the share price has tripled since then, more than tripled. No, quadrupled since then. I cannot do maths. Quadrupled. It's gone from 666 to 29.34. Should I end it there? Should I keep on going? Ooh, there's a few other companies that I'm trading here. ALQ, I'm not trading this, but it did get above this purple box. That was a trade because it got above it, then fell back in. I should have bought then, and then share price has taken off. This chart, well, if you exclude between 2013 and 16, although that makes sense. This is more of a mining services company, something along those lines. And that was the weakness in the iron ore sector. And the share price found a bottom in early 2016. So this is correlated to iron ore. I would do an iron ore correlation with ALS. And I would say there is a pretty good correlation just based off what I see in 2015 and 16, which is interesting. Otherwise, if you exclude that, actually has the makings of a high quality chart. It has the makings of a chart of a high quality company. Dexus, I have no interest in this one. And you can see why. Why is this a 3-month high? Is this really a 3-month high? Oh, it is. It just. Yeah, the last time it was this high was back in October. Yeah, okay, just. This is sometimes why I like 6-month high, because it excludes stuff like this. And QUB, I am trading this one. I think this is expensive, but the share price just keeps on going up. I was actually really hesitant to take a trade in this one, but I saw a sign and I thought, oh, why not? And I suppose I am up a little bit, but this is one where I will be willing to sell just because of valuation. And then below this, we have Hub, Ansell, which is another one I'm trading. By the way, Hub, I was trading, and then I took profits. Mistake. Flight Center. Flight Center? Really? Flight Center? I know. I was looking at this chart going, let's have a look at the daily chart. Oh, okay. Yeah. Massive drop. That was in October, and the share price just got above the highs we saw. Oh, that's interesting. I didn't expect that one. Genesis Minerals, Eagers Automotive, Capricorn Metals, Tours, another one I'm trading, Ramilius, Emerald, Vault Minerals. These all have markup above $2 billion, by the way. Ingenia, Communities, Corporate Travel Management. I took a trading position in that just the other day. The Tower Royalties, I was going to have a look at this chart just because it's starting to look interesting. Mega Cheese, beautiful uptrend for a while. Temple Webster trading that one. Babcor, Monodelphous, beautiful breakout about 2 or 3 weeks ago. Oh, there's a lot of companies here. I'm going to have to go through some of these. Karoon has just taken off the last few days. And Ingham's, that's interesting as well. Okay, that's all I've got for this video. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.